Hi, everyone. It's John Pocoroba. It's October the 9th. I thought I would put out a general market update. It's a busy week with blue sky coming up this Saturday, but I thought we would try to get in a short update. Again, as a reminder, I'm an amateur individual growth stock investor, and I'm not affiliated with IBD or MarketSmith, though I've been practicing can, slim, and variations over the past almost 20 years. Again, a reminder, big blue sky event is this weekend. If you have not registered, the link is right here on the right side. Please do so. I think you'll find the content is extremely valuable content that typically would cost thousands of dollars. So please take advantage of this event. It's on Saturday. Even if you can't attend live, you can get the recordings if you sign up, because they'll be posted for unlimited viewing for 30 days. So quick overview of the big picture, some internals and market bottoms, some things we're looking for, and then we're going to share some watch list names. So again, typical monthly chart of the NASDAQ that I show, you'll notice that we're consistently, still muddled down in this yellow zone where between 10,000 and 11,000, where really the bull super cycle is being tested. I used this slide a couple of weeks ago, just giving the context. We're really at this kind of confluence of a number of different markers. We have the June low, the 61.8 retracement. If you're a Fibonacci person, the pre-COVID peak roughly was around 10,000, a very psychological level. So a lot of particular support levels are into play, kind of in a zone I have shown in yellow. If that zone gets broken, there's not a lot of support. So it's a real test. Just wanted to go back to some of the basics of the economic cycle versus the stock market cycle. The economic cycle in this wheel, you'll notice over the past year, I've been slowly moving this red arrow around the dial. I think we're somewhere in here where, we have seen some of the energies and material stocks peak, though some energy is trying to make a rebound today. But we're definitely headed towards, with the Fed being hawkish, we're headed towards potentially recession. On the left, more importantly, is to understand that the stock market cycle will peak out and also bottom out before the economic cycle. So the blue line is actually the stock market cycle, and I'm showing an arrow that we're probably in between middle to late bear market. And then the economic cycle, as you can see here in yellow. And the numbers correspond to different sectors that outperform in various parts of the cycle. So let's quickly go over some internals. I pulled up this slide from March 10th. This is the March 10th update, and this is exactly what I said back then, what we'd be looking for in trying to find a market bottom. And we had a rally breadth. We talked about positive divergences, a follow-through day, a little bit on sentiment, which is a secondary indicator, the news, and then what kind of action in growth stocks should be happening, and where the quality bases and new names. So this is what we talked about in March. I wanted to share, I tweeted out a few things on the sentiment side. The National Association of Active Investment Managers, the 2-week moving average had moved down to, this is level of exposure. They were way down in the 10% level of exposure. And you usually see that under 20% is usually around market bottoms. Now this is as of September 28th. I tweeted out the put call ratio and the equities, as well as the AAII survey of over a week ago. And both of them were starting to reach really extreme levels, but we've seen that before, put to call, and bearishness is really, really high at the retail level, 61% as of September 28th. And I put out this chart on my Twitter. This is the S&P index, and this is where the index made a new low. The S&P probed a new low, but if you were paying attention to some of the internals, the broader market did not make more new lows. We had 1083 at this mark of the new low, and then as the S&P plumbed a new low, we actually had 420 new lows, and that's really what we refer to as a positive divergence from the index, less lows, and it shows that maybe the broader market is breaking this monolith of bearishness, but time will tell us if that's true, or we actually will go lower. But it's certainly an early sign that maybe we're getting there. Now, on the counterpoint to that is the New York Advanced Decline line doesn't look good at all. You'll notice that the advanced decline line, broke to new lows before the index, and you can see it's continuing to break to new lows. So this is not a good sign if you're a bull. And this is as of Friday. The new highs minus new lows on the New York Stock Exchange. In red, this is where I marked there are less new lows as the index hit lows. Now, new lows are starting to pick up again on Wednesday, Thursday, and Friday of last week. So we want to watch this. If the index goes to a new low again, we want to see what happens if we get another positive divergence and see what really occurs underneath the surface. So this remains on our watch list. So if I were to go back to the things we're looking for back in March, and I kind of said, well, what's our scorecard today? Here's how I would assess it. The first criteria was to get rally attempts with breadth improving, meaning the advanced decline line leading stocks. And I would say we're neutral. Monday and Tuesday last week, we had a nice breadth days, good days. But unfortunately, Wednesday through Friday really ruined that. We had much more decliners than advancers. So this is really a neutral. Did we have a positive divergence? As I mentioned, we did have one when the index plumbed a new low. So that's a yes. Have we seen the third condition, which is a follow-through day? No, we have not seen a follow-through day, and I've been consistently tweeting that don't get too anxious to get back into the market until we see more evidence that we might get a rally. Sentiment, yes, we have seen the AAI Bull Bear survey reach extremes, as well as a few other sentiment indicators, but I will remind everyone that sentiment is not something to trade off of. It really is a secondary or even tertiary indicator to confirm some other more primary indicators like the advanced decline line. The news will be horrible. I really believe we are seeing the news is horrible. You're seeing everything about negative things about the hawkishness of the Fed, inflation, rates. It really is a lot of bombardment of bad news. Now, the interesting part about that is with this latest round of bad news, the market touched a new low, but it didn't break apart. Now, that could change tomorrow and we could really, really flush down. But I think it's actually a little bit contrary that the market didn't blow apart last week and we had more consistent hawkish comments from multiple Fed governors, which is almost extreme comments where they commented about there will be no Fed cuts in 2023. And I'm not sure how they can possibly say that. They don't know what the conditions will be. I really believe that, if there's liquidity problems in the system and global connections to other world economies, the Fed is going to have to engage in that. I mean, they say they won't, but they're going to have to if it starts to affect the US markets. So we'll have to see how it plays out. Now, growth names stop going down or go up on bad news, which is kind of a sign that they're actually sold out. I would rate this a neutral. Like I said, it's been a lot of bad news, and some of the growth names that have come up off the bottom, yes, they're coming back down, but they're not completely blowing apart. There's definitely some stresses on those stocks that we're starting to lead, but we'll have to see if they completely collapse or not. But for right now, I'd rate it neutral. And then looking for quality bases and new names. I would say that there's not a huge quantity of quality bases and new names on relative strength, but there are, I would say, a good 10, 15 that are worthy of your watch list. So I would rank this again neutral. Now, if you're interested in my other favorite indicators, go to the general market update on July 1st on my YouTube channel, and you'll be able to hear all the other indicators that I look at in looking at market bottoms. So even though it seems really, really, there's a lot of bearishness out there, you still have to keep doing your work. You follow your routines, you build your watch list, and you try to be prepared so when the market turns. I mentioned that you're looking for stocks for your watch list. We have to be aware that many stocks are off 50, 60%. So you're probably going to see a situation where they come up the right side, hopefully a 20, 25% uptrend, and then they build a quality base under accumulation. So we're looking for those. And if you did find some stocks that had only corrected 10, 20, 30%, That's an even stronger condition. There's very few of those, but that's a stronger condition for building your watch list. I can't emphasize enough the prior uptrend if you're a position trader. My study of the 55 greatest winners showed that all of them really had strong prior uptrends before they based out and had very strong moves. In some cases, in many cases, over 100% uptrend before the stock went on its major move. So it's something that I like to see in place to show that a stock really is showing some strength before it builds a quality base showing accumulation. So let's look at a couple things that I tweeted last week. I mentioned that we're in a very volatile, choppy market. It's probably a market to be mostly in cash. You'll notice that a number of double bottom bases are forming, and I've shown 6 on the screen. Double bottoms are very common when you're in volatile, choppy markets. And if you go to How to Make Money in Stocks, you'll see all the criteria for a proper double bottom. I will say that it needs to be a minimum of 7 weeks, with the second leg undercutting the first leg. But there are some here that are showing up in some of the potential stocks that might lead the next advance. So here's some stocks that I think are very interesting for your watch list. Shift4 Payments is a payment processor. They're really focused on retail and hospitality. But you can just see by the numbers, they are growing their revenues very steadily, and these are not insignificant numbers in terms of $500 million in revenue. And you can see it's a profitable company with some very strong earnings, and the estimates for 22 and 23 are very strong. This stock has moved up off the bottom with an uptrend, prior uptrend, and is building a flat base. That looks very interesting. Certainly with the pressure of the general market, it's probably a good stock to have on your watch list. Wolfspeed is a semiconductor stock. They basically have a new product using silicon carbide. Again, the estimates are very strong. They're building out factories to ramp up for the demand for this kind of chip, which is actually has a lot of qualities to it that are better than other chips in auto and other applications in electric vehicles and charging stations. Another stock that looks really interesting, holding up fairly well given we are at the lows right now in the indexes. Neocrene Biosciences, this is a biotech. This is a biotech that actually has sales and it actually has earnings, which makes it of more of interest to me. I try to stay away from the ones that have no earnings and sale, which are really speculative. You'll notice that this one actually has a very strong estimate. They have a drug that is selling very well, and they have 2 others in the pipeline. You notice the up to down volume ratio is very strong, and it's been forming a flat base. And if you get into the details of this flat base, it is showing net accumulation. And you'll notice that it tried to break out early last week, but with the general market's weight, it's pulled it back down. So it's definitely something that, this false breakout, but it's still a strong stock that I would keep on your watch list, good return on equity, and good participation by funds. So I think it's one of the more interesting biotechs. Shockwave Medical, I've mentioned this one before. This has a lot of the qualities you see in big leading stocks. And what I mean by it has accelerating earnings and sales. You can see very strong earnings. It's profitable. It's showing profitability in 2023. You'll notice that funds have been increasing for 3 quarters in a row. Anytime you see funds over 400, that's pretty meaningful in terms of institutional sponsorship. So this is an interesting story. They make a shock technique to break up calcium in your arteries. It's basically a new way that's disrupting the industry. It's better than stents and balloons. And the most interesting thing to me is they really have no competition in this space. So these are qualities that are really important in a leading stock. So that's one to watch. Also, Paylocity, again, is forming a nice flat base after a earnings gap up. It's consolidated nicely. There you see the nice uptrend, and it has very consistent sales, and its sales are strong as well. Return on equity for a software name of 34% is very good. And you'll notice that pretty solid estimates in 2023 and 24. So with that, I wanted to give you a few ideas to keep on your watch list. It's important to stay engaged. And again, a reminder, next Saturday, we'll be starting at 10 a.m. Eastern time. This is going to be a fantastic day. We have great speakers, lots of people signing up. So it's going to be a great event. We're going to have some raffles for some of the books of these speakers, and can't encourage you enough to take advantage of this incredible event. It's on Zoom. You'll have access to the videos for 30 days. So please join us. I think you really won't regret it. So that's all we have time for now. Look forward to seeing you everybody on Saturday, and we'll go over the next general market update. Thanks, everyone.